The next thing is to discuss a model for effective financial analysis. This is adopted from a model for effective financial analysis from Paul Brown. It's from the Journal of Financial Statement Analysis in the summer of '98. Even though it's over 20 years old, it still is very foundational and gives us a framework. I think if we can operate within a framework, it gives us something to look to refer to, and it has a lot of support and validity to it. So the first thing that come out when we're doing it is the 6-step process is what are the economic characteristics and current condition of the industry in which a firm competes. Now, we have already talked about the macro trends, GDP, and the policy implications. How do we now apply that to the company we're looking at? So we have that background. Now we need to expand it into the specific industry in which your firm does business. You need to also look at the strategies that the firm engages in. What are the strategies for success? What are they doing for the future to be competitive, to grow? So we need to understand them in a very quantitative way. We want to then assess how well the firm's statements reflect economic effects of the decisions and actions. So what we want to do is, if we know what the strategies are, did they do them? How well did they execute them? That requires us to take a look at the financial statements of the firm from a historical perspective, understanding some of the accounting nuances, if you will, the principles and methods, whether that be under GAAP, generally accepted accounting principles, or under IFRS, International Financial Reporting Standards. Are there adjustments needed to improve the quality of the information? We will spend time on that. We assess the profit and risks of the firm using ratios and other analytical tools. Forecasts, then. We forecast the profitability and risk incorporating information on here's what they're going to do, here's what they say they're going to do. We have to develop a forecast that incorporates that, and then what's going on in the industry, what's going on in these macro trends to come up with a forecast. Then we're going to value the firm using various methods and making a decision, comparing likely price ranges. So this is our foundation here, is Paul Brown's model. Now, also in this brief section, I've actually included his whole article. So I encourage you to read it. If you have any questions, just let me know.